Imagine it's March 2009. The global economy is in free fall. You decide to invest $10,000 in the planet's most hated companies. Companies currently being investigated by Congress, sued by governments, and publicly blamed for the worst financial panic since the Great Depression. These specific companies took billions of dollars in highly toxic subprime mortgages, stamped them with their highest possible safety rating, and sold them off as secure investments. When those mortgages inevitably defaulted, the world lost $250 billion. If you had made that highly questionable $10,000 investment back then, today it would be worth over $400,000. Legendary investors like Warren Buffett saw the panic, bought the stock, and currently remain massive shareholders. Look at the global credit ratings market. When normal financial institutions make catastrophic errors, they go bankrupt. Lehman Brothers collapsed completely. But Moody's and Standard & Poor's survived their disastrous ratings, and together they still completely control 95% of this market today. A $250 billion catastrophe somehow made the exact companies responsible for it wealthier than ever before. We need to figure out exactly how their business model is built to be so indestructible. The answer starts at the core of the global bond market. Investors around the world need a way to figure out if it's safe to lend their money to a Spanish corporation or the Japanese government. This vertical gauge shows exactly how the agencies solve that problem. They issue a credit rating, a simple solvency test expressed in letters. AAA means maximum safety, cascading all the way down to D for complete default. But the entire global financial system hinges on one specific red line: the strict division between BBB, considered investment grade, and BB, which is considered speculative or a junk bond. Massive pension funds were legally forbidden from holding junk bonds. If an agency downgrades your country's debt below that line, dozens of funds are legally forced to sell your bonds immediately. The price plummets, your financing costs skyrocket, and your government enters a deadly debt spiral. Two private companies sitting in Manhattan hold the literal power to bankrupt a sovereign nation with a single keystroke. Zooming in from the global economy to a single corporate transaction reveals the brilliant yet highly conflicted engine driving this power: the issuer pays model. The company asking to be judged is the one paying the judge. This scale shows exactly why corporations gladly hand over a $500,000 fee for a rating. Having an official AA rating drops the interest rate lenders charge them. On a $1 billion bond, that rate drop saves the company $40 million every single year. The return on investment is more than 80 times the fee. And this exact mathematical incentive is what caused the housing bubble to explode. Investment banks grouped thousands of terrible, highly likely to default mortgages granted to people with zero income or savings into complex financial products called CDOs. The banks then paid S&P and Moody's millions of dollars per product to review them. S&P and Moody's obliged by stamping these toxic boxes of bad debt with their AAA rating. Internal emails later proved analysts knew the assets were garbage, but they also knew if they didn't give the banks the AAA rating, the banks would take their million-dollar fees down the street. Forced to choose between protecting the integrity of the global financial system and collecting massive corporate fees, the agencies chose the fees. When those toxic mortgages finally defaulted, they brought the global banking system down with them. In the aftermath of the crash, outraged governments passed sweeping regulations designed to break up this oligopoly and introduce competition. But they slammed directly into a deeply entrenched defensive moat. The first defense is universal language. When a banker says a bond is AAA, every investor on Earth knows exactly what that means. You could invent a superior rating system tomorrow, but no one would buy it because everyone already speaks S&P. The second defense is the regulation itself. The laws passed after the 2008 crisis were incredibly complex and expensive to comply with. Instead of fostering competition, the massive compliance costs bankrupted new competitors before they could even enter the market. The final defenses are network effects and infinite demand. The more investors rely on the ratings, the more issuers are forced to buy them. And global debt continues to surge, recently passing $102 trillion. Every single dollar of that debt needs to be constantly refinanced, rated, and billed.
The public outrage and complex government interventions didn't dismantle the monopoly. They accidentally fortified it, permanently locking in their 95% market share. The legal consequences for the crisis reflect this unassailable position. S&P and Moody's faced lawsuits, but settled out of court for roughly $800 million each. That is a rounding error for a crisis that erased $250 billion of global wealth. No executives went to prison. Lawmakers failed to dent their armor. But recently, S&P and Moody's saw their stock prices briefly plummet by 20%, driven entirely by the sudden emergence of a completely different threat: artificial intelligence. The market briefly panicked, realizing that advanced AI models might soon be able to audit balance sheets and calculate default risk faster, cheaper, and more objectively than a human ratings agency ever could, completely bypassing the issuer pays conflict of interest. AI might slowly erode their margins over the next decade, but if governments forced S&P and Moody's to shut their doors tomorrow, the global bond market would instantly freeze. Nations would be entirely unable to fund their operations or refinance their national debts. These companies didn't survive the 2008 crash because they were innocent. They survived because the exact structure of the global economy makes them indispensable. If the system physically cannot function without your product, you are protected from any consequence.